Hello, everyone. Welcome to the first episode from the Industrial Brief. Today's episode is about the CFO Mindset, principles of cash, profit, and capital. So let's brief it.
Today, we're going to try and turn the pretty complex world of corporate finance into something crystal clear. We're really focusing on what creates value in a business, beyond just the glossy numbers you might see on an income statement. So we're going to dive into the mind of a chief financial officer, a CFO, because they really live by a completely different set of rules than, say, the sales or marketing team. And we're tackling this paradox that trips up so many companies, fast-growing ones and old ones alike. How can a company look so profitable on paper with fantastic revenue growth and then all of a sudden find itself completely bankrupt?
Well, that paradox is really the key, isn't it? It's the difference between recording a sale and actually having money in the bank.
Right.
It just exposes this tension between accounting and, actual survival. And if you had to boil down the job of a top-tier CFO to just one thing, it would be this. They have to relentlessly manage the timing mismatch between cash flowing in and cash flowing out. And on top of that, they have to allocate every single dollar of capital only to projects that deliver returns above the cost of that money.
Yeah.
That's it. That's the discipline.
That really shifts the focus, doesn't it? It's not just about making sales. It's about mastering the clock and being smart about every dollar you spend. It reminds me of that famous saying, what is it? Revenue is ego, profit is opinion, cash is fact.
And capital allocation is leadership.
Exactly.
It's a battle cry for a reason, because it's completely true. Revenue makes everyone feel good. Profit. Well, profit can be manipulated by accounting choices. It's an opinion.
But cash is a fact.
Cash is a verifiable deposit in the bank. So our mission today is to break down the three pillars a great CFO has to manage all at the same time to make that profitable opinion an undeniable cash fact.
Okay, let's unpack that. 3 interdependent pillars, and you're saying if you miss even one of them, the whole thing just breaks.
The entire system fractures.
Yeah.
We can think of them as answering 3 questions: survival, value, and growth. The first one is cash timing, which is really just liquidity. It answers the question, can we pay the bills today?
Okay, so not about last quarter's profit.
Not at all. It's about when cash arrives versus when it leaves. This is the absolute survival layer.
And the second pillar?
The second is economic profitability. This goes way beyond net income. It asks, are we actually creating wealth for our owners? And that means generating returns that are genuinely above what it costs to get that capital in the first place. That's the value creation layer.
And the third?
And finally, the highest level is capital allocation. This is the growth engine. It's where every dollar, whether you earned it or borrowed it, gets a job.
So is it going to growth, paying down debt, or just sitting there as a safety buffer?
Exactly. Or is it being wasted? That's the ultimate act of leadership.
Let's start at the bottom then. Pillar 1, cash timing.
Okay.
Because, like you said, survival has to come first.
It absolutely does. A sales team is focused on revenue first, but a CFO's rule book is inverted. It's cash first, profit second, and growth third.
You have to be solvent today to worry about growth tomorrow.
You got it. You have to be.
So how do they manage this? What are the actual levers they pull?
It's actually pretty practical. We're talking about a few key things. First, how quickly we get paid by customers. That's your days sales outstanding, or DSO.
DSO, got it.
Then you have how much cash is tied up in stuff you haven't sold yet. Inventory. That's days inventory outstanding, or DIO.
Okay.
And then on the flip side, how long we can take to pay our own suppliers. That's days payable outstanding, or DPO.
So they're trying to speed up the inflows from customers and strategically slow down the outflows to suppliers without making them angry, I assume?
Precisely. And all those levers feed into one single critical metric, the cash conversion cycle, or CCC.
The CCC.
It just tells you the number of days that your cash is literally trapped inside your company's operations. You calculate it as DSO plus DIO minus DPO. And the longer that cycle is, the more the company is basically forced to be its own bank, funding everything out of pocket, often with really expensive debt.
What a burden. Okay, so that's survival. Let's talk about thriving. Pillar 2, economic profitability. You said something earlier that I think is really important. If your profit doesn't exceed the cost of your money, you're actually destroying value.
You are actively destroying it. People miss this because the P&L can be so misleading. I mean, imagine you borrow $1 million at 8% interest for a new project.
Okay.
If that project only generates a 6% return on that capital, you're losing 2% every single year. You're busy, you're generating revenue, your P&L might even show a tiny profit.
But you're making your owners poorer.
You are making them poorer with every transaction. You're taking on value-destroying activity.
So the job here is really about maximizing the return and minimizing the cost of capital. That must take some serious discipline.
It's brutal in execution. The labors aren't glamorous. It's just rigorous pricing discipline, having the nerve to walk away from a bad deal. It's ironclad cost control so your expenses don't creep up. And it's mastering the margin mix.
Let's stick with margin mix for a second. That means steering the whole company toward the products that generate the highest quality dollars, right? Not just the highest volume.
Exactly. Even if it means selling less overall.
But that sounds great in theory. How do you tell your sales team to stop selling a high-volume product? I mean, don't you risk immediate backlash?
That's where the real leadership comes in. It's a culture shift. The CFO has to align the entire organization from sales commissions to how you measure success with economic value, not just top-line growth.
Right.
They have to show the sales team with hard data which contracts are actually destroying wealth. It takes real courage to say, we are stopping a $5 million line of business because it's losing us money.
That's powerful. You're basically redefining what winning looks like internally. Okay, let's make this real. We've got the 3 pillars. Let's look at this case study you mentioned. The industrial services company that looked so healthy. On paper, this firm was crushing it. $50 million in annual revenue.
A very healthy 35% gross margin. And they were pulling a 12% EBIT margin down to a reported net profit of $4 million. From the outside, you'd think, great investment.
But profit is opinion.
Exactly. Now let's look at the cash timing reality that was strangling this business. Let's look at their cash conversion cycle. First, their customers paid very, very slowly. Their days sales outstanding, their DSO, was 120 days.
4 months. Wow.
4 months. Then they held a lot of inventory. Their DIO was 60 days. But here's the killer. They were paying their suppliers in just 30 days.
Ouch. So they're a great customer, but terrible at funding themselves.
Terrible. So that timing mismatch is just, it's immediately obvious. Let's do the math on the CCC.
Right.
It's DSO 120 plus DIO 60 minus DPO, which is 30.
So 120 plus 60 is 180 minus 30. That's 150 days.
A staggering 150 days.
150 days. So this company, with its $4 million profit, was financing 5 full months of its own costs before a single dollar came back from the customer.
That is the definition of value destruction.
Yep.
And the consequence was devastating. To fund that 150-day gap, they had roughly $15 million in cash trapped in their operations at all times.
And that wasn't free money.
No, not at all. It was being funded by short-term loans and overdrafts at a painful 9% interest rate.
9% on $15 million. That's
Right.
Let me see. That's a $1.35 million annual cash drain.
Yep.
Just keep the lights on. That eats up more than a third of their reported profit. No wonder they felt stressed all the time.
Constantly stressed and high risk. And this is where a great CFO steps in and moves to pillar 3, strategic capital allocation. The intervention was a 3-pronged attack. First, fix the cash timing. They went right after the DSO. They started strict milestone billing and required advance payments on new contracts.
But how did they get customers who were used to 120 days to actually change?
They tied the cost back to the service. They offered small discounts for paying in 60 days and started strictly enforcing late fees after 90. It caused some noise, sure, but it worked. They hammered that DSO down from 120 to a manageable 75 days.
Wow, cut it almost in half.
Almost. And at the same time, they optimized inventory, getting DIO down from 60 to 45 days. And they renegotiated with suppliers, extending DPO from 30 to 45 days.
So let's see the new reality. 75 days DSO plus 45 days DIO minus 45 days DPO.
The new cash conversion cycle is 75 days.
75. They cut it exactly in half.
And that single operational improvement instantly released $7.5 million in working capital. Money that was just sitting there funding the bank's loan portfolio was now back in their control.
Incredible. $7.5 million found not from some new investor, but just from internal discipline. What about Pillar 2, the profitability part?
They protected margins. They used the new data to vet every single contract. They actively stopped taking on low-margin work that tied up their capital. They repriced their service bundles.
And what was the result?
The overall gross margin improved from 35% to 38%. The sales team was now incentivized on the quality of the margin, not just the volume.
So now we get to Pillar 3, capital allocation. They have $7.5 million of newly freed cash. What do they do with it?
Every dollar has to have a job. And doing nothing is a bad decision too.
Yeah.
So first, they paid down the bulk of that expensive 9% debt. That instantly eliminated the $1.35 million annual cash drain.
Smart.
Second, they funded a few selective, high-return growth projects they knew could deliver an 18% return. And third, they built a healthy safety cash buffer.
So what was the final outcome after a year?
The transformation was dramatic. Revenue only went up slightly, from $50 million to $52 million.
Just not a huge sales jump.
No. But because of this intense focus on the three pillars, the EBIT margin jumped from 12% to 15%. And most importantly, net profit skyrocketed from $4 million to a robust $6 million.
That's a 50% increase in net profit with almost no change in revenue. Debt is down, cash flow is under control. It really wasn't magic. It was just time management and financial logic.
That's it. The huge boost in profit and valuation came entirely from disciplined management of the cash cycle and relentless capital logic. They went from being a business that survived on revenue to one that created economic value through its structure.
That really is the difference between just surviving another year and truly building long-term wealth. For anyone listening, that cash conversion cycle is pure survival. But mastering where you put every dollar, that's leadership.
And that brings us right back to the core. A great CFO ensures every single dollar invested is earning a return above the true cost of that money. If a project fails that test, it's destroying value no matter how much revenue it plunges in.
So we've seen how a profitable company can be completely cash-starved. We've seen how interventions can release millions. So for you, the listener, here's something to think about. Since the CFO's job is to constantly manage this and avoid that crisis, what are the specific early warning signs they're watching for every single week? And building on that, how exactly does fast, undisciplined growth actually kill a company even faster than a recession? What really stands out to you in this analysis?
That brings us to the end of this episode. Thank you for listening, and I hope you found it valuable. Until next time, I'm Abdurrahman Hawass, and this is the Industrial Brief.